Well, it can. I don't personally want to see that. I would rather see this one fail. That's what I'd like to see. I would like to see that one fail. Meaning that since we went to the top of it here and here, if you split that inefficiency in half, I want to see it stay in the upper half. If it has any retracements, I don't want to see it go back in the lower half. Okay. So right away, we're talking about how to look for fair value gaps that shouldn't be viewed as a shorting opportunity because you would have been stopped or very close to being stopped out already. Because the rules are whatever the fair value gap is that has the imbalance candle, there's always three. Okay. There's three candles that make a fair value gap. Your eye is being trained, Caleb. For the most part, he can see these, but they're not always jumping out at him because, especially if there's multiple fair value gaps, okay, or what would be considered visually representing a fair value gap. Like he would look at this one and he would look at this one. And if there's multiple ones, it's like, which one do you use? It's the same questions that all of you are leaving in my comment section, the same ones that my private students sometimes they'll ask me. It's you want a nuts to bolts. This is what you're doing. That's what we're covering this week. Okay. The whole week is going to be specific to that. But you have to let me talk about the details, okay? Because it's not just one sentence. There's going to be variations to certain things. That way, when you write them down, when you take screenshots, every time I draw attention, like I mentioned this one here, you should already have that screenshot. You should, let me get this out of the way. That should be screenshotted right there, okay? So some of you saw this one right here, and maybe you did take the short in here. And if you would have used the rules that a valid fair value gap employs, the stop loss would be above the number two candle in the three candlestick formation that makes a fair value gap. So if we look at it like this, and let's make it a little taller. Okay. One candle, two, and three. If the market has moved lower, this candlestick in the middle, that is your kind of like your trigger candle. That's the one you're watching to see stay open. This is number one candle. This is number two candle. Number two candle is where your stop loss is. That's your, if you're really trying to use the most leverage, not that that's something you should be encouraged to hear. I'm not trying to encourage you to over leverage, but if you're going to be using maximum leverage, you're placing your stop loss right there. The conservative stop, where you're not over leveraging, where you're a one contract trader and you're just not trying to push it too hard and you like to be comfortable in your trade, you don't be scared out, you don't be worrying about too much of every fluctuation. The number one candle is where your stop loss is. Okay, so right away, we've already cleared the air and removed all the confusion about where stop losses go and what candlestick is the trigger. If the market price is down below here and you're looking for lower prices, even still lower than that, if the market trades up, this candlestick, number three, this is your entry. That candlestick's high or one tick below it. If you're absolutely 100% certain that you believe strongly that it's going to drop, I will use a one tick below that candlestick's high. Now, you can do something like this. Don't worry, there's plenty of fair value gaps for me to trade off of. Just focus here first. We have to lay the groundwork. You'll see me pushing buttons today. Just sit your fucking ass still. The low and the high, that is your consequent encroachment of this hypothetical fair value gap. Okay? So this to this candlestick's high, that's your sweet spot. In a perfect world, if all things being perfect, this is your ideal entry point right in here. Now I'm going to tell you why we are not supply and demand, and you can put the middle finger up to everybody that tries to say that that's what it is, because today you're going to find out with the science behind why it's not. Zones, we don't deal with zones, and you want to screenshot that, okay? So we've seen it go down into the lower half of this SIBI, which is a fair value gap that has a down close. It knocked out anyone that went short, traded down once more to the consequent encroachment, a mohawk, which is just coloring outside the lines, and trading up into that end all new day opening gap. And this is again Friday's new day opening gap. Right here, the liquidity is this. That's your buy side. Right there. And then up here is mid gap, or consequent encroachment of the opening range gap. And that's all that we need to worry about at this moment for you, Caleb. Okay, so we have a small little gap in here. Notice it's over here. It's the same thing, just going lower. So we have a fair value gap there, and we have a fair value gap right there. This, to me, isolates all this price action. So I view this as a balanced price range. I would prefer it not to see that fill in. It doesn't mean if it goes down and fills it and touches this candlestick's high or the small little volume bounce that has to be included. Like if you're drawing this fair value gap here, you can't just use the wick like that. That's not valid. That's not valid. You want to use the volume imbalance that's part of and inside of. What am I doing here? Okay, yeah. That's incorrect. This that's valid because you're taking in consideration that the difference between the two bodies that they are not touching. So you have to have all the way down to the previous candle, or number one candle in this case, which is the opposite of this. Okay, so we want to see it trade above the end dog, come back down. It can use the top or the midpoint of that, spring from that up into the minor buy side, maybe hopefully accelerate and reach into that mid gap. And we still got about 7 minutes or so to see if we can hit that mid gap, because all again 70% of the time, it's not 100%, 70% of the time mid gap gets hit within the first 30 minutes. So back to this discussion here for fair value gaps. We're not supply and demand. We don't trade in zones. So since number 3 candle, that is your entry candle. Number 2 candle is your framing of the fair value gap. What's the part that's the area where price should come back and revisit it? It's the candle that has no previous candles low touching the next candle after. In other words, in a perfect world, this candlestick should touch this candlestick and have a bridge between those two price points. But as we see here, it's being shown with just one candlestick. So it's one pass through or single delivery between this candlestick's low to where this candle makes its high. So as soon as the next candle, number 4, opens, you have a valid reason to anticipate a return back up into that fair value gap. It may not do so. It may just keep on dropping down. If it does, just let it do it. Don't worry about it, because your focus rather, should be in the mid part of the gap that is framed by this candlestick's low and this candlestick's high. And if you drop a fib on it, Same thing is accomplished when you put the little horizontal line on your rectangles, when you drop your rectangles in and you go to style. This midline is basically going to give you the same thing that you get when you put a Fibonacci on it and have the 50% level. It's consequent encroachment. It's the midpoint. If we're bearish, the ideal optimal entries are going to be formed at the lower half. Why? Because you want to see that upper half, this level up to this candlestick's low, stay open. You want that to remain open, because if it does, that means you have a very strong probability that you're right and you're going to be on side. And that's a fun thing to be on. And there's signatures that the algorithm signals to you that that's what it's trying to do. And you don't have to worry about it. You're not fearful of it. You're ready to smoke that minor buy side. You're already grinning, aren't you? Thinking, man, this guy's literally teaching what the future holds. Not for everybody. A lot of you guys are going to tap out. You're not going to want to do the work. But why we are not trading in zones? Okay. Well, this looks like a zone, ICT. You're shading this area here. There are specific price levels. This low of that candle number 1 to candle number 3's high. That's what I have a Fibonacci on, hypothetically, because these are just candles I drew out. They're not there. The same thing we're going to look at on the actual fair value gaps in price. But this is the stuff that you write down and you draw this out in your notebook, okay? You're welcome, here, get it out of the way. You're welcome to take that screenshot like that and then scribble all of your notes around that. But what you're looking for is, I personally, this is my favorite way of doing it. Because if you look at my charts when I'm doing executions, you might see where I'm just a little bit ahead of a fair value gap, or I'm just a little bit ahead of a bearish order block, because I know what I'm looking for. So I want to make sure I get filled, because I'm trying to trade in markets that are very heavy when I'm bearish, or very, very light and more likely to run higher when I'm bullish. So I want to make sure I get filled. I don't like missing my entries. I'm not worried about missing the trade. I have 81 ways to get into that same trade. But the thing is that you are not learning how to trade a zone. There's very specific price levels. And what are they? They're this. It's the high of candle number 3 when you're trading a bearish fair value gap. Look at that, buy side. Look at that. Who does it like this? Patrick, you watching? Take notes, brother. So that price right there, if it trades up into that, you can be short. I would be short 1 tick below this candlestick's high. And then if it trades up to the lower quadrant of this gap, I'm adding 1 more. What do you think I'm adding there? That's the 4 contracts. So I'm going to enter short. I'm not saying this is, let me slow down real quick, but I'm just teaching you by theory what you watch me do all the time in my examples. Okay, I'm doing this and I'm repeating it over and over and over and over again. And it's something that you're going to be able to do if you practice this. Okay. Entry 6 contracts at candle number 3's high, less 1 tick. If I'm not there at the time to get that on, as soon as it trades to this candlestick's high as it's happening, I'm going short right at the market. And then I'm watching price. I want to see price kiss that lower quadrant level that makes that fair value gaps range. Okay. I'm going to add 4 more there. And then whatever I feel comfortable with, if I get another opportunity to short, that'll happen if it touches consequent encroachment. If, and it doesn't always happen, if it trades up in the upper half. In other words, it does this. Now we're up in the upper region. Now I have a real deep discount. I'm sorry, premium. I'm trying to sell at an extremely high price. Then what I'm going to do is I'm going to toss in like 2 contracts, 2 more contracts. As long as it's spending time up in here and it keeps tapping, and if it shows the body staying inside of this candlestick's low, number 1 candle's low, I will allow it to wick through that. And it's okay for it to do that, because my stop loss is going to be resting 1 tick above this candlestick's high. It's going to take a real move to disrupt that. And I already know, as I proved here, I know how to find fair value gaps that fail, and I will tell you why that one was not a good one. So settle down. You're screaming at the monitor, dude. Tell me why you didn't bleed. I'm gonna tell you. Trust me. It's all part of the purchase price of coming here today. No refunds. So we have this level here that we allow for the wicks to form through it, but we don't ever want to see the bodies close above it. We don't want to see that. So that's how I'm internalizing what I'm expecting when price is trading up into the fair value gap. My entry price point is specific. It's not, how do I get in this zone? How do I trade this zone? That's bullshit. We have to know what levels we're trading. Okay. So if it's going to trade in above the midpoint and it's giving me a real high premium price, what price level am I going to aim for there? The upper quadrant level. Now tell me, how's that for logic? It's not ambiguous. It's not milli vanilli. Okay, you don't know what you're getting. I know exactly what I'm looking for. I know exactly what price I'm aiming for. And I know exactly where my stop loss is going to be at. I'm not guessing. I'm not wondering where I should put it at. I'm not worrying about if it's going to get hit, because if it hits it, then that's wonderful. That I just paid a premium for information. I got new intel. That means I'm probably looking at an inversion fair value gap, and I can mitigate that loss very easily.